Nilesh Shah joins us, Managing Director and CEO with Envision Capital. You're the only man with smile.
You make us smile, Nikunj.
You know, they say good investors love bear markets because you get stocks to buy. I mean, are you feeling the same? That, oh, it's a bear market, let's start buying stocks.
I mean, I don't know about the bear market, but clearly, obviously, there's been a very sharp correction, and a lot of stocks have are coming towards a very attractive kind of level. The big question is that how long does the uncertainty last? How long does this volatility last? Because clearly, the tremors or the echoes of what's happening probably will be felt for some more time. This is really not like kind of a one event which just comes and goes. This is not like COVID, where all the governments put together collectively worked towards solving the problem. This is not like 9/11, or this is not like the 2008 crisis, where all the central banks worked collectively together to pretty much find a solution and take on the challenge. This is an era of unilateralism. Lots of state actors at play out there globally. So it's going to take some time for things to essentially kind of settle down and normalize. So it's not about, really about valuations or stock prices. It's honestly more about how long this uncertainty lasts.
As an Indian investor, Nilesh, what should one do? It's a little later, I guess, to throw in the towel, but you're wondering whatever little profits you're sitting on, do you need to exit that as well? And, just sit on cash, wait for this uncertainty to subside whenever it does, because unfortunately, it's not in our hands, really. It's now seeming to be a very EU-China versus US kind of story, and that's going to dictate the global growth trajectory. And, you're wondering what really to do because it's really uncertain.
Yeah, no, I don't think this is a time to kind of take really cash calls. Clearly, a lot of stock prices have fallen and fallen meaningfully. And it's always going to basically very difficult to really call the bottom. We also have to keep in mind that typically markets do tend to bottom out way before you see any improvement in the fundamentals or any improvement in the earnings. To that extent, we have to bear that in mind that markets can bottom out way ahead of things normalizing. So I don't think this is really a time to necessarily sit in cash. I think it's time to be constructive. It's time to be proactive. There's a lot of the fear, uncertainty, which is basically kind of getting factored into stock prices. So to that extent, I think this is a time to kind of go back to the drawing table and see what kind of an impact one sees in terms of this whole new tariff regime that is unfolding, or a possible global slowdown, or a possible recession in the United States. And in that context, one has to essentially keep evaluating sectors, one has to keep evaluating opportunities, rather than necessarily be tied down by the direction of the market.
Nilesh, good morning. This is Shrishti also joining in. So when you say that it's not a time to sit on cash and maybe it's time to go back on the drawing board, help us understand that which are the sectors that one should be looking at this point in time, because just after this near-term dust settles in or the volatility actually settles down a bit, which is the place that investors should go and hide at this point in time in the near term, and the long-term opportunities, where are you spotting?
So a few things. One is clearly that in the recent times, a lot has been done to put more money in the hands of the consumers. The tax breaks that were announced in the most recent budget, the kind of direct benefit transfers that are happening through various schemes of the state governments directly in the hands of women, is all leaving more disposable income and more spending power in the hands of Indian households and in the hands of Indian consumers. On top of that, with a steep fall in crude oil prices, raw material costs essentially are going to be lower, which will drive margins. So the best place to currently be in is the consumer space. And consumer space is totally inward facing, or is dependent on domestic demand. So there is basically a potential for consumer companies to essentially grow revenues and to expand margins, and therefore to drive earnings. So that clearly is one space. The second space essentially are the digital platforms. Digital platforms, again, are powered by both rising consumer aspirations, urbanization, and digitization. all three put together, I think, are a great combination. So a lot of the digital platform businesses are unaffected by what's really happening. So I think that's again one more great place to be in. The third is the opportunity around infrastructure development and industrial expansion are again a place to be. They don't get affected by what's really happening globally. And that's really where the role of the government will come in terms of both a policy regime towards tariffs or to promote asset creation or to promote infrastructure development. So that's again going to be a great. So all these pockets or set of opportunities really are not dependent on global growth or what's happening in the United States. So clearly believe this is a set of these kind of opportunities are a great place to be. And on top of that, again, financials are again a domestic-led opportunity. So I think there are a whole bunch of opportunities which are coming in, and the current market kind of correction or a meltdown is basically, I think, creates several opportunities.
You know, if world slows down, decision making will get delayed. Look at government spending as an example. Because of election, it got delayed. It took 1% out of India's GDP. Right now, if we speak to corporates, they're saying we've stopped production. We don't know where to expand. We don't know how to expand. The sentiment is not great on the capex side suddenly at a global level. So it's a matter of time. It will start biting demand, supply, or for that matter, even fresh capex. Won't that hit us then?
So in terms of consumer demand, I don't see that getting impacted. And we also saw during the COVID period that, people thought people would sit at home and there would be no demand. But look at it. I mean, yes, it lasted for a few months or a few quarters, but after that, there was essentially a very, very sharp, I would say, revenge shopping, which happened. But I really don't see these set of events to actually impact consumer-led demand or the consumption-related sectors. So to that extent, I'm less worried on that. I totally agree that maybe private capex is something which might basically take a backseat as companies and managements basically wait for some more clarity and see how this uncertainty essentially is going to settle down. It's also going to wait for different policy responses as well. But these are some things which I don't think will take probably more than a quarter or two to basically iron out. So yes, maybe for a quarter or two, there would be essentially some pullback in terms of investment-led demand or capacity creation, if I would kind of use that phrase. I probably think, yes, there will be some setback, there's some pullback, but I don't think it's something which is going to get permanently impacted. I think clearly over in maybe 1 or 2 quarters from now, you actually will see corporate India sensing this actually to be an opportunity where now, because the tariffs on India, the tariffs imposed on India are relatively less compared to our Asian peers. And maybe there is essentially once again a very massive export-led opportunity for manufacturing companies. And I'm reasonably confident that this is going to be more an opportunity, and corporate India will turn this adversity into an opportunity along with support from the government. So I'm not too worried on that count as well. It's probably a question of a couple of quarters, but post that, I clearly think you're going to see again growth come back and an all-round comprehensive growth come back.
Expect anything magical from Q1 earnings season, or it's going to be nothing short of disaster? Because I mean, I'm with corporate India when they say that we don't know. If they don't know, how will they tell us?
Yeah, no, I think it's too early. I think this whole development is barely a week old, so it's still too early. I probably think yes, maybe in a couple of weeks from now we'll have more clarity, but I'd probably say that it will still take a few months for clarity to emerge. Keep in mind that I think the timelines which were set for a bilateral trade agreement with the United States was something like September, October. Maybe this development pretty much expedites that process. It fast forwards that process. So it's quite possible that it may not even probably last till September, October, but that's a reasonable time frame. I would put basically for a fair bit of clarity and uncertainty to emerge. In between, we are also kind of been an era of lower inflation. We could be in a period of lower interest rates. And all of that will actually act as some kind of incentive for corporate India to basically take very concrete action plans. So while I agree that it's going to be a little more calibrated, but maybe after the initial J curve in terms of a decision making, you will essentially see then corporate India beginning to accelerate and have their eyes set on the global opportunity, which is now emerging because of this event.
Uh, while we all know your views on IT and you've maintained for a while now that, the heydays of the large cap IT services plays are behind us. But given, IT's susceptibility to whether the US goes into recession or not, what happens to growth there, and then thereby, the discretionary spends as well. Tell me, when do you think IT stocks could bottom out in case there is a recession? Let's assume the worst case scenario. And I ask because we've in any case gone through a bad churn in the IT stocks and they've already fallen a whole lot.
Yep. So that's a great question. And, one thing which I would want to kind of really say that while right now the street is very concerned on the prospects for IT companies, we have to keep in mind that our IT companies, a very large part of their revenues come in basically from non-discretionary spending by Fortune 500 companies, which is essentially demand coming in because of application of IT, maintenance of IT services, or a bit of the transformation which every company undertakes at very, very regular intervals. So I really don't see demand for Indian IT services to fall off a cliff. Bear in mind that even during the 2008 global financial crisis, IT companies did not degrow even 1 or 2 years later, despite the fact that the global financial crisis so far on a relative term was a significantly more than what we are seeing today. So I'm not too worried. Just that, our IT services companies are not, the large IT services companies are not great growth stocks. Even in the last 10 years where there have been so much of, progress, prosperity all around, or growth all around, our IT services companies have grown in single digit in rupee terms, at best 10%. In dollar terms, it's been a lot lower. So it's been like kind of a mid single digit growth thing. So to that extent, I don't think one should even look at them as really growth stocks. I think the opportunity will get created. And if you look at the last many years, IT services companies have traded between, say, 17, 18p multiple on a trailing basis to maybe on the higher side, about 30 times trailing earnings. They're probably currently, a bellwether like Infosys is trading at about 20, 21 times probably on a trailing earnings basis. Maybe a 10 to 20% lower from here, it would create basically a good value buying opportunity. But I don't think that should essentially be mistaken for buying into, a sector or a business which is a high growth sector.
FIs were selling because dollar was strengthening and yields were going up. Right now, yields have gone to 4.5 because inflation fear is back. How does one look at these moving parts in the world? One side I can say, oh, crude is down, thank you. Other side, I can look at dollar index and say, okay, great, 102, 103, great. But I look at deals and I say, okay, this is the real deal, 4.5%, which is where it is right now. So how does one look at this global macro interplay, which will have impact of 5 to 10% in the near term?
Yeah, it will surely have an impact, undoubtedly. But I think inflation in the United States is less led by crude. I think inflation in the United States is more led by consumer spending and not necessarily. I think the sensitivity to crude oil prices is a lot less versus the kind of sensitivity which basically a country like India has, because we import probably 80-85% of our energy requirement. So to that extent, I probably think that while inflation in the United States, unless the United States slips into a recession, which is a possibility, then probably we will see yields basically soften along with basically fall in broader prices across a basket of goods and services. I think versus that, India seems to be in a really soft space. The crude correction in a lot of metal prices, all of that, I think augurs well from our inflation point of view. And keep in mind that, our central bank has basically kept interest rates, relatively higher for a very long period of time. I mean, for a couple of years, at least, I think it was in a pause mode. My view is that we are heading towards lower inflation. I think that's going to basically encourage the Reserve Bank of India over a period of time to keep cutting interest rates. And to me, I see that as basically a very, very strong booster dose for our economy. So we are way more sensitive to crude oil prices, to liquidity, to interest rates versus maybe, versus maybe many of the global developed economies. So I think the two situations, I think two scenarios that are unfolding are very different. In the short term, we would still be very kind of correlated. We probably move in the same direction. But I probably think, over the medium term, India will emerge to be kind of a pretty much a standout destination.
Nilesh, in this uncertain time, what kind of an asset allocation strategy would you advise in this uncertain global climate?
No, so obviously for the principal protection part of your portfolio, I would still think that obviously you have to be in fixed income. If interest rates are lower, bond prices go up. So there's going to be an appreciation on the fixed income part of it. Maybe it might be a good idea to also move, if people are holding on to gold, given the sharp run up that we have seen. Maybe I think gold becomes also as vulnerable, though it's being touted about as basically the safety place or the safe haven. But I clearly don't believe so. So obviously for principal protection and those who are really worried about volatility, maybe still fixed income might be a better place. But nevertheless, I would still actually think that equities over the medium to long term has the potential to deliver double-digit kind of returns. That's been the case so far. And I don't see that changing given the fact that India itself, nominal GDP growth will grow at about 10%. So I'd still think that this is a time still to be in equities and maybe use this current bout of correction to keep increasing allocation to equities depending upon one's own risk appetite.
Nilesh, so, you've already told us what you like. Tell me what looks like a complete avoid right now.
So clearly for now, the tough spots clearly are the IT and the pharma because they're significantly export-facing sectors. They are basically hugely dependent upon how the US does and how's demand from US. And on top of that, of course, we have the tariff thing. So clearly for now, one has to really be very careful and cautious about export-oriented companies or export-oriented sectors. So that's one place to kind of really maybe avoid in this environment. But I still think the demand for pharma is going to be inelastic. I mean, no matter what tariffs are imposed, I don't see why suddenly there's going to be an alternative source for the United States to basically buy its pharmaceutical requirements, irrespective of the tariffs imposed. So I think we will live with some uncertainty. Maybe, in a few weeks, few months now, even these two pockets would probably create very attractive buying opportunities. Metals is something which one would avoid right now because, again, it's a factor of global demand, global prices. There's really nothing more to basically metals. So I think industrial metals is one area that one should basically be avoiding very, very clearly in this environment. Also, I think the capital market oriented sectors with this basically correction and maybe a bit of the investor sentiment getting impacted, you're going to see basically some impact on capital market facing kind of sectors or capital market facing stocks. So maybe that's one area where you would probably want to wait to kind of add to your positions or buy afresh. So maybe these are some of the sectors where one has to be cautious right now.
Discuss macro, micro, tariffs. अब stocks बताते हैं. What are you buying, selling? Simple.
No, I don't think as I said, we're still kind of using these opportunities, buying into some of these digital platforms, buying into consumer stocks. These are really the pockets where we are buying into.
Market stocks, but you own Angel One. So am I missing on something or have you sold Angel One?
No, we are still holding Angel One. As I said that, yes, we still like the medium to long term. The whole wave on theme of financialization still is in a very nascent stage as far as India is concerned. And we believe that some of these platform companies are essentially great executors. They have done a phenomenal job so far. It's just that there are headwinds for them right now. But clearly, I mean, this time will also pass. And maybe a few months from now, they would be back onto the growth trajectory. So I think we remain very confident of the long-term potential and the ability of these managements to execute.
Today's interaction by simply saying that Indian investors should not panic, but they should be alert. Will that be a fair statement? Don't panic.
No, I don't think it's time to panic. No, I don't think. I mean, I think just go back. The big bear markets that we have seen during COVID, that we have seen during the global financial crisis, or during basically the 9/11 times. These bear markets do last for 6 to 9 months. We peaked out about 6 months ago. Maybe it's a question of another 3 to 6 months. It's better to kind of bide the time and be more prepared for the next round of up move. And I don't think India's long-term bull market has basically got impacted in any way. The long-term bull market still remains. I actually believe that we have really not seen foreign capital come into India in the last 3 to 5 years, and I'm talking of foreign portfolio investors. I'm saying from portfolio investors. I'm not referring to FDI. I actually believe that over the next few years, you're really going to see a lot of, I mean, domestic money, of course, has been coming in, but I also see a lot of foreign portfolio investors coming into India. India could actually end up being a mainstream allocation. So apart from essentially earnings growth and strong fundamentals for the Indian economy, I also see a new round of liquidity flowing into Indian markets down the line. So I'm honestly, this is not a time to chicken out. This is not a time to kind of get too worried, or definitely not the time to panic. This is really the time to kind of remain constructive and look for the opportunity ahead.
On that happy and positive note, Nilesh, we'll await by to see what the MPC has to do. Hopefully, it should be a more than 25 bips cut, and let's await a market reaction to that. But good chatting with you as always.
Thank you so much.